closing bell on Wall Street, and now it's market domination overtime. Jared Blicker going to be along in a moment to help get us up to speed on what happened today. And I'm going to start with the major averages here. We saw the Dow closing near the highs of the session here, up 619 points on the day. That's a gain of 1.5%. This morning, we did see a little bit of bumping around in the red before the rally into the weekend at that. Interesting to see, as we do see the president express some optimism about getting a deal done with China. We don't know what the timeline is, but there's still been a lot of concern about the effects on the tariffs on imported items from that country, even as their tariff rate on U.S. goods is going to go to 125%. The S&P 500 up 1.8% on the session, and the Nasdaq Composite winning the day, up by 2.1%. Jared's got a closer look at today's action now.
Thank you, Julie. I'm going to look at a 5-day here of the S&P 500. Just point something out real briefly. You know, we had that huge day on 4/9. That's April 9th, Wednesday, when we went up 12% in the Nasdaq. But the last 4 days, either 75% of the S&P 500 issues have been going all up together or down together, and it's been one after the other. So we went down, then up, then down, and today we're going up again. And that just tells you that the internals are all moving together in the same direction. And that's kind of what happens in a bear market, even though the S&P 500 not officially in one just yet. 4,800 is my line in the sand. I'm going to do a deep dive with Josh on that in about 30 minutes. Here's the VIX. The VIX actually came down this week after jumping up on Monday, but it's net down from last Friday. But that doesn't speak as to realized volatility. This is VIX is kind of looking to the future there over the next 30 days. Huge week in the bond market, biggest jump in the U.S. 10-year T-note yield since 2001. And if you take a look at the 30-year, that is the biggest jump since 1982. So as big as the moves were in stocks, it was even bigger in the bond market. And let's check out some of the sector action, everything in the green today. And if we take a look at a 5-day print here, only real estate in the red and energy almost break even there. But check out tech. Tech up almost 9%. Industrials up 6.5%. Both of those outperforming. And let's switch over to the NASDAQ 100 to get a picture of what happened this week. Lots of nice green there, although it has been very harrowing, I will say. That's what happened this week. Let's check out what happened today. Still a lot of green on the screen, although we're seeing Meta in the red for about 50 basis points or 0.5%. Tesla down just slightly. And if we take a look at some of our leaders here, we see today just about everything in the green. KRE is regional banks, so those took a little bit of a drop, and then LQD is a bond ETF. So just about everything else in the green. Who was leading? Bitcoin. Bitcoin up 5.5% today. Then we got Korean stocks. Then we got some smaller energy stocks, and then solar, biotech. And by the way, biotech had a rough day, has been having a rough couple days this week. But if we take a look at what's happening in some of the smaller names, and I like to look at the ARK Innovation Fund, if we sort by equal weight, where Tesla doesn't have that huge dominating market cap weighted spot over to the left, we see a lot of green here. So maybe some incremental improvement here, but again, I go back. If we go too much farther down in the S&P 500, we trigger that bear market level. I'm just worried that we kind of hit the elevator to the downside. Back to you guys.
Thank you, Jared. For more on the market action, let's bring in now Jed Ellerbrook, portfolio manager at Argent Capital Management. Jed, it's good to see you. So let's talk earnings, Jed, because we did get those big banks this morning. So I'm interested, Jed, one, what do you make of those big bank reports? And two, your broader expectations for this earnings season, Jed. What do you expect to see in here?
Yeah, I thought big bank earnings today were about as good as could be expected. JP Morgan put up pretty good results, did not revise down their credit loss estimate for this year. Growth was about as expected. The investment bank, banking activity on the weak side, but trading activity strong. Obviously weakness in investment management with the markets down, but the core banking business, net interest income, doing well. JP Morgan is a standout performer in its industry, of course. And then Wells Fargo, maybe not quite as strong, but still reasonably decent results. I think we'll see estimate trends for the next couple quarters maybe trickle down a couple percent, which, given everything we've experienced over the last month, is probably not a bad outcome. And then, earnings season broadly, as we head into it here, I think we're going to be seeing earnings estimates declining as companies face the reality of a lot less visibility, a lot of uncertainty in terms of how customers are going to react to rising prices, declining stock market, and still high mortgage rates, et cetera.
And Jed, what all is said and done for the year, do you think we'll end up seeing much earnings growth?
No, I don't. We came into 2025 expecting S&P 500 earnings to grow about 15%. That's already trickled down to 11% here today, and I think that's going to continue moderating through the year. It wouldn't surprise me at all if we end the year with no growth at all or perhaps slight declines.
And how much of that, Jed, is already reflected in the market, in your opinion?
Yeah, that's a good question. I think some of it is, obviously, with the market's down, north of 15% from its highs. But there is a humongous amount of uncertainty. And that uncertainty builds by the day, I think. I think businesses are hesitant to engage in M&A activity. I think consumers are probably pulling back on, travel plans, home improvement plans, all kinds of big ticket things. So the longer this uncertainty lasts, the more damage it does.
When we are looking ahead to the next phase of earnings, or I guess the next phase that's going to get a lot of attention, big cap tech is what I'm thinking about. We saw it lead the gains once again today, kind of coming back and recovering. And there's going to be a lot of attention on those AI spending plans from large tech companies and whether they are still intact. Do you think they will be? And if they're not, will investors think that it's sort of a logical and reasonably cautious thing to do for them to cut those plans, or will there be disappointment?
Yeah, great question. I think 2025 CapEx plans for big tech are largely locked in. Google told us that this week at their event. They're going to stick to the $75 billion for 2025. I think Microsoft, Amazon, Meta will tell us the same thing. 2026 is probably the big question. There's a lot of investor concern, obviously, with regard to that. You see that, with Broadcom and NVIDIA's stock prices down. Arista's another one recently. So, yeah, there's a lot of consternation as to AI infrastructure spending. I do believe, though, that businesses are going to continue, pretty quickly with their AI journey, deploying AI tools into their business because it's a huge cost savings tool. And I think businesses are going to get more interested in cost savings as this economic uncertainty has risen.
Jed, always great to have you on the show. Thanks so much for joining us.
Have a great day.
You too. Coming up, closer look at companies pricing out China risks, more market domination overtime when we return. The U.S. dollar has been a global benchmark for decades, but President Trump could be stirring up some trouble for the currency. And Yahoo Finance's senior columnist, Rick Newman, joins us now with more. Rick.
Hey, guys. When Donald Trump says America first, does anybody think that means devaluing the dollar and investors around the world selling U.S. assets, including stocks and bonds, both at the same time, which is contrary to decades of historical trends? I don't think that. But that is what has been happening, and this is generating some alarm among investors who see, when there's a big stock sell-off, as we've seen recently. Of course, we've had a few rebound days, but overall, we're still way down. What normally happens is people buy U.S. Treasury bonds and long-term interest rates go down, and we've been seeing the opposite. People have been selling U.S. Treasury securities, which is pushing interest rates up. That is not what normally happens. So you're starting to see some analysis. I mean, the bond market, it's not like it's a monolith. It's not like bond investors are always doing the same thing for the same reasons. But analysts are starting to read into this that the U.S. is just beginning to look like a less desirable investing climate. And investors are saying this is going to be an uncertain investing climate for as long as Donald Trump is in office. And there are other things we can do. Gold is getting a lot of interest, obviously. Central banks in other countries don't want to hold as much U.S. Treasury securities anymore. And if this trend persists, this is a really big deal because to remind everybody, we have a gigantic federal debt in the United States, and it's only going to get bigger with Trump pushing for deficit finance tax cuts, which is just going to mean we need more Treasury debt on the market. And if the appetite for that debt is declining, that can only mean interest rates have to go up, which would be basically bad for everybody. So Trump's trade war, it just gets worse every week. And every Friday I come on and try to summarize what's happening, and it's basically turning into a disaster.
Rick, how will we know if indeed that foreign appetite for U.S. assets is declining? I mean, there's been some speculation that that's one of the things that's been driving what's going on in the Treasury market, but we don't know for sure.
What investors seem to hope happens is that Trump gets the message, and he says, "Okay, I cannot mess with the bond market because I will lose," and he will lose. And of course, we saw a hint of that on Wednesday, April 9th, when Trump he delayed the so-called reciprocal tariffs. But at the same time, Trump put the tariff on Chinese imports all the way up to 145%. That is absurdly high. That tariff on Chinese imports is so high that some trade experts say Chinese ships won't even leave ports. No one will even buy those goods until because they're going to wait and see, does something happen? What is the next shoe to drop here? And it turns out that by getting rid of one set of tariffs, but putting the other ones on China so high, we still end up with an average tariff rate of around 27%. That's 10 times higher. The tax on imports is now 10 times higher than it was when Trump took office barely two months ago. So investors are hoping that Trump will say, I'm not going to mess with this. But Trump seems to be sort of dabbling to see how much he can get away with. And he's obviously willing to tolerate some losses among regular people, not among himself, I guess. And the question is, how far will he go? And I think that is part of the process of losing confidence, which is that adverse reactions in markets have not had very much impact on Trump so far. And this could become a self-fulfilling prophecy if it continues.
Rick, thank you. Good to see you.
Bye, guys.
China announced Friday that it will raise tariffs on U.S. goods from 84% to 125%. It's the latest salvo in an escalating trade war between the world's two largest economies that has rattled markets and raised fears of a global slowdown. Joining us now, Isaac Stonefish, Strategy Risks founder and CEO. Isaac, it's been a little while since we've talked, certainly since this back and forth really heated up here. And as someone who is a close student of this relationship between the U.S. and China, is it impossible to predict what happens next? What are some of your best guesses as to how things develop from here?
With the caveat that these have to be guesses, I do think the recent... We are basically at the bottom of where things are going to go in the near term. I do think the relation is going to devolve in months, years. I think this is just a taste of what's to come, but I do feel like with this roller coaster, we're going to go down perhaps a little bit more, and then relations will improve. China will come to the negotiating table. The two sides will potentially strike some sort of deal. And then 6 months, a year, 2 years later, things will be far, far worse.
Isaac, I wonder, what do you think the risks are that Beijing starts to really go after American companies, Isaac, that do a lot of business in China? And what could that look like?
So for folks who are in the trenches there, they know that Beijing has been making it a very inhospitable place to do business for years, if not longer. And I do think you're right. I do think things could get quite worse. I think what they could see are tax irregularities, permitting problems, harassment, arrest, torture of workers. And I do want to point out for American companies, their Chinese staff are far more vulnerable. And so when Beijing targets individuals working at American companies in China, usually it's the Chinese employees who bear the brunt of it.
And Isaac, so you're an American CEO. You're hearing this right now. You're listening to this. What do you do, Isaac?
So what you do is threefold. You better price your China risk, which means looking at all of your partnerships with Chinese entities, your supply chain, your joint ventures. You make sure that you're taking care of your staff and you put safety first, and you do not put your Chinese staff in the line of fire. And you come up with a plan for what happens if the US and China stop just fighting a trade war and have an actual war. What do you do in that case to make sure that you are protected and that your business can go on, not as usual because things would be radically different, but that you have a plan in place?
Now, Isaac, we've talked about that potential for an actual war in the past. Where are we on that sort of likelihood continuum at this point of the trade war?
I think, and again, so difficult to predict, I think this is not going to be the last straw, or as the Chinese say, the spark that causes the prairie fire. I think there's going to be a deal. The markets will have a very false lull, and then something else will spark a conflict or a war in months, or more likely several years. So again, caveat, prediction, but that's what I think right now.
Isaac, what are the chances you think that Beijing takes advantage of, all this drama, all this volatility, and does invade Taiwan? I'm curious what odds you would put on that. And if they did, Isaac, what you think the American response would be?
I think what we're going to see much more likely is a push. And Beijing loves sending out these sonar pings, sending out signals to see the level of resolve. So I think what we're going to see is cyber attack against Taiwan, or additional types of blockades, more military presence over Taiwan, and then see how Taiwan responds, see how the United States responds, and also see how Japan responds. We often forget how close Japan is to Taiwan and how much a Chinese-owned Taiwan would threaten Japan. So if China does that and there's very little pushback from the rest of the world, then I do think the chances are good of an invasion in the near term. I think if the US and Japan and Taiwan do push back, then I assume Beijing backs down for now.
And Isaac, we've been hearing some interesting anecdotal evidence of the fallout, sort of the initial fallout here. One of the stories we saw today, Bloomberg reporting that Five Below, the discount retailer, has, through its shipping company, asked to pause some of its vendor shipments from China. Do you expect us to see much more of that? And then, even though China has said it's not going to raise the tariffs of stuff coming into China anymore, are there other measures that you expect?
When you talk to companies that source from China, they talk about the price being attractive, but they also talk about the predictability and the volume. The idea that, I can really make these very large orders coming from China. And what we're seeing, and this is really a feature of the trade war, not a bug, we're seeing increased unpredictability. And so I think a lot of other retailers are going to follow suit. The real question for us in this space is how transparent are they going to be about it? Are they going to make announcements? Is the reporting going to come out like it did with Five Below, that they are really reducing their China supply chain exposure? Or is that something we're going to have to find out and sort of guess at based on other reported information?
Isaac, I'm curious, though. Xi Jinping finds himself in this position where his economy, Isaac, has been sputtering, right? You can argue it was just starting to try and find its footing, and now he finds himself in this fight with Trump and the U.S. How secure is his position?
The trillion-dollar question, it's really difficult to know. And there's been some credible reports of a very serious purge at the top of the Chinese military, which should remember is not an independent military, but an arm of the Communist Party. And that could either be a really important sign of insecurity or a sign of his ability to exert more control and influence. But I do think your question is the most important issue. How secure is his control and power? People will often say, China craves stability. No, it's that Beijing and Xi Jinping craves control. And so any indications on that are very, very important signals for investors.
And so, Isaac, just to wrap up here, what is sort of the one big piece of advice that you're giving to clients right now when it comes to this relationship?
Twofold, if I can cheat on the question. One
Yes.
is deep breath. These are stressful times, and you will get through it. Don't say, I'm going to put my head under the desk at things like this. But the second is really better price your China risk. Understand that this relationship is likely to unravel, and make sure that you have a plan in place, you have alternative suppliers, and then you have a really good understanding of what your China footprint is so that you can move quickly and take advantage of opportunities as they do open up.
Isaac, always great to have you on the show. Have a great weekend.
Thank you.
Time now for what to watch next week, starting off on Big Tech. Meta facing off against the Federal Trade Commission on Monday in an antitrust trial that may result in breaking up the company. Trial centers around the FTC's allegations that Meta is monopolizing the social networking market.
Shifting to the economy, we'll be getting some insight into the consumer with U.S. retail sales on Wednesday. Economists forecast total sales to increase to 1.4%, while core retail sales slow to 0.4% on a month-over-month basis.
And taking a look at the Fed, we're going to hear from more Fed presidents throughout the week. This is coming after comments today from Boston Fed President Susan Collins. Collins telling Yahoo Finance that she expects to hold rates for longer, but that a cut may still be possible at the end of 2025.
And moving over to housing, the monthly home builder confidence index comes out on Wednesday. That number expected to decline to 37. That would make it 3 straight drops in a row. And that'll give us more insight into home builder sentiment in the U.S.
And sticking with housing, we're going to be getting monthly housing starts and building permits data on Thursday. Economists expecting both starts and permits to decrease in March to 1.41 million and 1.45 million, respectively, on a month-over-month basis.
Stick around. We got more market domination coming on the other side.
Well, U.S. stocks closed higher to end a volatile week with the S&P 500 posting its best week since 2023. Yahoo Finance's Jared Blickry joins us now with the trading day takeaways. Jared.
Thank you, Josh. You're going to have to forgive me if I put best in scare quotes there. We have had some historic market moves this week, and we're going to talk a lot about volatility, but I just want to go down some of the market moves that we saw. I'll start with the bond market. So we had the biggest increase in yields. This is a 10-year yield since 2001 this
Massive,
week. And then if you look at the 30-year, biggest since 1982. So that's basically before any investor here was really doing their thing. So we've just had to deal with a lot of new information. And then, yes, we had some historic drops, and we also had some historic gains. What I found really interesting in the S&P 500 is that the last 4 days, either 85% of all the issues have been going up or they've been going down. And so first we went down, and then we went up, then we went down, then we went up again. And so you're wondering why we feel a little bit shell-shocked here and are not celebrating this best weekend however many years. That is why, my friend.
So volatility was up this week, Jared, or would it depend how I look at it?
Exactly. It depends how you look at it, because the VIX, and I can chart this, the VIX actually dropped. It jumped up to 60, and then it had a net decline from the previous week. That's implied volatility. However, what I was just talking about is actual volatility. This is a 5-day price action in the S&P 500. This is realized volatility. So just to round out the discussion here, let me take a look at the VIX, and you can see over the last 5 days, we started out at 60, ended up at 37, but that is still pretty elevated historically speaking. Also have a couple more charts I want to show you real quickly here. This is going back to 1980, and this is a 4-week trading range. And right now we're about 7.5%. So that means over the last 4 weeks, the weekly range has averaged 7.5%. You're going to see as I draw this line across, we've been here before, but it's not exactly an extreme. We saw a bigger extreme in the pandemic, in the global financial crisis, 87 crash. And so we are not at the tipping point yet for this full-blown bear market. And I extended the analysis even further. This goes back to the Great Depression, and this is plotting only those moves over 3% and under 3% to cut out the noise in the middle there. And you can see in the Great Depression, we had a lot of volatile days. Then we kind of cooled off for a few decades. Then in the 1980s, when we had the first bull market in quite a long time, we saw a bunch of volatility there. Then the dot-com boom and bust. Then we saw the global financial crisis, then the pandemic. And here's where we are right now. We had this huge upside day. That was when the S&P was up, 8%, something like that. NASDAQ up 12%. We haven't had these huge down days that match the pandemic. But my thesis is if we move below 4,800 in the S&P 500, we're going to get some more of those.
Finally, any uncertainty hedges to talk about?
Guess what? Gold. Gold now up to about $2,500 an ounce. Let's just chart it so we can get the actual prices. Gold got sold off. It was kind of like a baby with the bathwater situation. So it had a nasty few days, but it has roared back. The last 3 days, it has been up 2% each of those days. It is up 10% this week, 10.2%. And let me put a 1-year chart on so you can see. Gold has just been a pretty steady provider of returns over the last year. and it has really accelerated. It just had its best week since the pandemic. That is the second best week this century. So all eyes on gold right now.
Finally, we're heading to the weekend. Bitcoin.
Oh, yeah, we got to check out Bitcoin as well. Bitcoin not soaring as much as gold, but it also didn't do as badly as stocks when we were getting those huge sell-off days. So let's just chart the price action in Bitcoin. This is over the last year, and it's interesting. You can see that we kind of had this top in here, we fell off, and we've been kind of trying to find a bottom here, but we didn't go that far. We didn't go as far as I thought we would. We're camping out above 80,000. I said 70 to 72,000 is my price target down here. We hit about 74, 75. So we could see some more downside in Bitcoin if we get that huge sell-off in equities. But for the most part, Bitcoin has been holding up better than a lot of other risk markets.
All right, we'll leave it there. Thank you, buddy. Appreciate it. Julie, back to you.
Thanks, guys. A new poll coming out from Allison Worldwide and Harris X is monitoring the auto industry as the tariff landscape rapidly changes. The results highlighting that U.S. consumers are anticipating vehicle prices to rise 14.4% during the next year. For more, we're bringing in Rebecca Lindland, Managing Director and Head of the Global Automotive Industry at Allison Worldwide. First of all, Rebecca, it's been a long time, and it is fantastic to see you. Well, Rebecca and I have been talking about cars for a long time, but it's been a minute. So, Rebecca, this report is really interesting. So if I'm a car shopper and I think that prices are going to go up 14%, does that mean I don't even bother to go to the dealership? Do I go and try to negotiate? What do you think this is going to mean for consumer behavior?
Yes. Well, first of all, Julie, it's so great to be on with you again. I'm so excited. I was delighted to see that you were going to be my partner in this. So yes, what's interesting and really important for consumers to know is that the current inventory of new and used cars on dealer lots today is not subject to tariffs, or to new tariffs, I should say. So if a dealer is trying to charge you a tariff upcharge, go to a different dealership because they're not subject to it. So while we do see consumers anticipating pricing rising, the current lot should be tariff-free. And so go and negotiate.
Rebecca, you also track how Americans are feeling right now about different brands, different models. What do you see, Rebecca? What do they prefer here?
Yeah, so Josh, what's interesting is that across the board, regardless of where a brand may originate, whether it's BMW or Toyota or a Chevrolet, all consumers that are shopping for, regardless of brand, all feel this concern. Consumers are worried about rising interest rates, which is interesting because the Fed's actually reduced interest rates in the last three times in the last quarter in 2024. So it's a matter of perception. So interest rates are actually getting better, but consumers don't feel like that. So, but it doesn't matter which brand you shop. All brands are subject to this perception that prices are going to rise.
And Rebecca, as you mentioned, the tariffs haven't yet hit the inventory that's in the lot, and there has been some evidence that there's been this sort of rush of buying as people try to beat the tariffs, so to speak. How long do you think that could last? Or I guess another way of asking it is, how much inventory do auto dealers have on the lot now before they have to get more cars in that could potentially be tariffed?
Right. Well, obviously every brand has a different level of inventory, some more than others. Of course, we've seen the announcement that Jaguar Land Rover will not be importing cars for right now. But so much of this is constantly changing, which is why Allison and Worldwide and Harris X, our partner agency, why we're working so closely together to monitor this situation. So again, it really just depends. What I would encourage consumers to do is to do your research, to talk to your dealer if you're in the midst of negotiating or looking at purchasing a vehicle. But we are seeing changes. So according to the survey that we just did, 41% of people surveyed are now unlikely to purchase or very unlikely to purchase a vehicle. And this is up from 28% just a couple of months ago. So we're definitely seeing a drawdown. We're definitely seeing a contraction in likelihood of purchasing.
For those who are interested though, Rebecca, I'm curious, what are they interested in? Is it traditional gas, hybrid, EV? What do you see in the data?
So we're continuing to see some constraints on electric vehicles in particular. And what's so interesting about this, Josh, is that in 2024, EVs accounted for about 8% of new car sales. And this is a pure battery electric vehicle. We still see about 8 to 9% of people saying, I'm planning on buying an electric vehicle. We just can't seem to get past the single digits, despite having a really wide range of electric vehicles available from all different brands, all different price points. It's just a matter of getting consumers into an EV. And I have to say that, there's fantastic experiences with electric vehicles. They have great torque. They're so much fun to drive. They have the latest technology, but consumers still are concerned about range anxiety and charging anxiety in particular.
Rebecca, we've been talking all about the consumer here, but I'm also curious about your perspective as a veteran of being connected within the auto industry, right? So I'm curious what you're hearing from your contacts, how they're feeling right now while all this is going on.
Yes, Julie, it's such a matter of wait and see. Each manufacturer has approached this quite differently. We have seen both Stellantis and Ford pushing the idea of not only are they largely American made, but they're also offering consumers employee discounts. So you can go in and as if you were like a Ford employee or a Dodge or Jeep or Ram employee. General Motors has taken a little bit different approach. We've seen them announcing a change for their light duty pickup trucks and consolidating some production at Fort Wayne, Indiana plant rather than in Canada and Mexico in an effort to avoid tariffs. Remember, of course, as your audience well knows, the automotive industry is highly capital intensive and it is very challenging for the industry to change. This is moving, you're talking about a giant ship trying to change course, and it's going to take time. But building where you sell is always a good policy. And that's what really the Trump administration is trying to do is get localized production and bring back to the U.S.
Rebecca, great to have you on the show today. Enjoy the weekend.
Thank you so much. You too. Great to see you both.
Thanks.
More market domination overtime right on the other side.
The tariff escalation between the U.S. and China casting a dark cloud over shares of Apple. The iPhone maker, being heavily reliant on China for its manufacturing, would face severe impacts from tariffs, especially if they stay at that current 145% rate from the U.S. to China. Our next guest, however, is seeing rising odds of some relief for the tech giant. CFRA Research Senior Equity Analyst Angela Zeno joining us now to discuss. Angela, there's been a lot of speculation about what these tariffs could do to iPhone prices here to the U.S. There's been reports that Apple did a special airlift through via India to get some of its iPhones out ahead of the tariffs. What does this imply for sort of the timeline of what we could see for iPhone pricing?
Yeah, I mean, and thanks for having me, Julie. But when we kind of think about this, I mean, in terms of pricing, we actually don't think there's going to be a hike in pricing across Apple's installed base until their next gen phones come out, so this fall back in September. And that's just typically how Apple handles pricing increases. You typically wait for that next gen device launch before increasing, and we think that's going to be the case again. We do think that if there's going to be a tariff situation like we're seeing now, the best time for it to come for Apple would be during your seasonally slower period, which is what's happening right now. Typically, the June quarter is your trough quarter. So from that perspective, if they've built up enough inventory and they can leverage whatever capacity they have in India, at least for their U.S. demand, they should be okay at least for a couple of months here. But clearly, as we start entering the fall months and into the holiday selling season, you're going to need to tap into that China capacity to meet, the higher expected U.S. demand. And at that point, there is going to be higher pricing, we think, irrelevant of what the tariff number is going to be, because it's at least going to be 10% and potentially a lot higher depending on how the U.S.-China dialogue goes.
Angela, do you think Apple could ultimately secure a special tariff exemption, a special tariff carve out like they did during Trump 1.0?
Yeah, I mean, so we've increased the odds, right, to 50% from 20%, and we really changed and increased our probability based on Wednesday's events. When you think about Wednesday, basically the U.S. administration reduced or eliminated or postponed the reciprocal tariffs. And essentially has a flat 10% rate here outside of China, whereas they actually increased the China rate up to now 145%, which really actually makes no sense for Apple to even touch that capacity there. So when you start thinking about the situation that has evolved there, it changes the competitive landscape in many respects, because right now you've got a company like Samsung, which is their biggest competitor out there. Most of their operations and capacity is in Vietnam, India, as well as South Korea. So in many respects, they've got a competitive advantage, especially as you start entering the holiday selling season here from a potential pricing perspective and cost perspective relative to that of Apple. So it'll be interesting to kind of see how the dynamics, kind of change here over the next couple of weeks and months. But if you're talking about a company in Apple, which is essentially, the crown jewel for the U.S., and they're committing $500 billion into the U.S. economy, helping to prop up kind of the manufacturing capacity in the U.S., a lot of it through funding across the supply chain to the likes of Taiwan Semi so they can build their plants here. You almost have to think that at some point in time, you're going to have to give Apple an exemption, but that's just our view.
So bottom line, you think Apple has a good argument for that exemption. Whether or not the White House buys that argument, I guess, is another thing.
Yeah, no, absolutely. And again, we think when you start thinking about kind of the added stress that's essentially put onto Apple kind of post Wednesday's events, now kind of, having a disadvantage from a competitive landscape, we just think it makes more sense or increasing sense to offer them that, that exemption.
Angelo, do you think domestic iPhone manufacturing, U.S. iPhone manufacturing, is that financially tenable?
Yeah, that's tough. I mean, any type of manufacturing for any goods on the chip manufacturing side of things and the hardware side of things, as far as the tech ecosystem is concerned, is very difficult. We all know about the slip up with Foxconn and them trying to build a $10 billion plant in Wisconsin back in 2017 and how that never came to fruition. Clearly we've seen some, like the likes of Taiwan Semi, find some success here. So we think Apple can move some supply chain manufacturing or push some of that here into the U.S. in terms of getting some of the other suppliers out there to build bases here. But overall, in terms of the assembly, testing, putting together building facilities as far as iPhones is concerned, it's just a stretch to us. I mean, from a cost perspective, it does not make any sense.
Angelo, I want to switch gears and talk about chips and the effect on chips of this U.S. and China trade war. We saw a steep drop today in shares of companies like Texas Instruments and Intel because China is saying that its tariffs that it's imposing on imports to China will matter where the country of origin is. So, for example, those two companies make some of their chips in the U.S. You didn't see other companies like NVIDIA or Qualcomm and AMD affected. In fact, they went up. How are you thinking about how to navigate the chip landscape with these very sort of specific regulations that are being put on each other?
Yeah, no, that's a great question. I mean, when you kind of just look in light of the events today, you clearly the names that, or at least the names that seem like they've gotten the reprieve are the leading edge companies. So your NVIDIAs, your AMDs, your Qualcomms of the world, because they are fabless companies and the manufacturing is based out in Taiwan there. And then your trailing edge type nodes, specifically your analog based companies, your Texas Instruments, ON Semis, Microchips of the world are the names that you would think would kind of get more pressured here. I would say, listen, when you think about China specifically, they are ramping up their domestic manufacturing industry there, and specifically where they are able to pump up a lot of volume is on the trailing edge side of things because they have the capacity there. And it's still very difficult for them to stay ahead of us or even kind of get anywhere near us in terms of the leading edge nodes. And they still need our chips, our GPUs, as well as other leading edge chips. So it makes sense not only from a chip origin perspective, but also from the perspective, from a strategic perspective for China. And whether or not that kind of was taken into account and all this remains to be seen. But from that perspective, we continue to think you want to be tethered to those leading edge companies that are more kind of tethered to the more profitable areas of the market until we see a sustained recovery in more cyclical markets like autos and industrials, where you could then start playing some of the more trailing edge nodes. But there's just too much risk at this point on that side of things, where we would continue to focus on your NVIDIAs and Broadcoms of the world.
And that's because, Angelo, despite the near-term sort of the drama, the volatility, you still think, obviously, that big AI trade and trend, that remains long-term intact?
We think it remains long-term intact. You may see some bumpiness. You may see some cuts here and there. But ultimately, when you kind of think especially when you look at the valuations of these things now, Broadcom, NVIDIA seeing significant pullbacks, we do think this is an opportunity, especially if you're a long-term investor, to get more aggressive on those names.
Angelo, great to see you as always. Thank you.
All right, thanks for having me.
Well, Trump tariff disruption has thrown a wrench in the Fed's soft landing as markets reel from whipsaw trading week. Stay with us. We're going to have much in our investor playbook coming right up.
It has been a volatile week in the markets, with them whipsawing from President Trump's tariffs. Yahoo Finance's Alexander Canals joining us now with our weekly investor playbook. Hey, Allie.
Yeah, what a week, guys. And it hasn't just been equities. We've seen volatile swings in safe haven assets as well, just aggressively selling off. If you take a look at the 30-year yield, it logged its biggest week since 1982. The 10-year yield, biggest week since 2001. Meanwhile, we've seen the U.S. dollar sharply weaken against foreign currencies. And this is very unusual. Typically, when we're in this period where there's concerns over stagflation, concerns over a recession, the potential impact that will have on the U.S. economy, we see investors flock to safe haven assets. But that hasn't happened. So what's been going on? Potentially, we have a loss in confidence when it comes to the entire U.S. financial marketplace, really. In addition to that, the potential impact of foreign buyers boycotting U.S. debt. If you think about treasuries, China, Japan, they're a big buyer of our debt. So we asked Wall Street experts these questions, what they make of this weird trading action that we've seen throughout the week. Here's more of what they had to say.
All of these really point to a coordinated move away from U.S. assets. And I think that is a trend that is likely to persist here in the short to medium term.
What people are concerned about is that maybe we're seeing a capital strike against the U.S., where large pools of capital are selling U.S. assets and taking their money home.
Yeah, I think it's a 50-50 shot at this point in terms of recession hitting this year. It's a shame because it looked like the Federal Reserve essentially had this soft landing in the bag in this huge tariff disruption, which is not over, has really thrown a monkey wrench into the soft landing.
And that was Michael Darda. He went on to say that a recession is more concerning to him than an increase of inflation, which experts have told us will likely happen now that the U.S. has escalated that trade war with China. We now have tariffs there of 145%. So just, weird trading action comboed with this back and forth trade policy, all those wonky headlines really sending investors for a tizzy this past week.
All right, Allie, thank you.
Thank you, Allie. And now here's what we're watching on the earnings front next week. United announcing results for the first quarter on Tuesday. Report providing another key indicator for the airline sector. Analysts expecting weaker demand to weigh on United's Q1 profit. Investors will listen closely for any commentary on the call about guidance. Earlier this week, remember, fellow airline Delta pulled its full-year guidance because of uncertainty from President Trump's tariffs.
And moving over to chips, Taiwan Semiconductors reporting first quarter earnings due out on Thursday. The company pledging $100 billion, remember, last month to build 5 new U.S. chip factories. Analysts expect a slight miss on revenue due to disruptions from January's earthquake, but much of the focus will be on the company's full-year guidance as it navigates a rapidly changing trade landscape.
And finally, we're going to be getting first quarter Netflix earnings after the close on Thursday. Remember, Netflix says it will no longer be disclosing its quarterly subscriber numbers starting this quarter. The analysts are still expecting that momentum to endure and drive revenue growth in Q1. Well, that is a wrap on today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.